Thank you very much for downloading this recording. I want to continue with group accounts basic, and this should be the last question that I would like you to do. I'm going to show you the key workings, and then you're going to straight on consolidate. We're told, according to the requirement, let me just go down there, this question. The requirements are as follows. After you have read your notes, you are being asked to prepare an income statement, that is a profit or loss, and a statement of financial position for the group for the year ended 31st March 20 something. Of course, that was not indicated there. Now, again, basic groups should not be problematic to most of us. All right, basic groups should not be a big problem to most of us. We have just to follow through these key steps. Determine your group structure, number one, and then go down. You determine your net assets for the subsidiary. Most of the times we do this work in order to establish what we call the post-acquisition profit for the sub. Then you go down to goodwill, you work out your goodwill, you go to NCI, then you come to group retained earnings, and then finally you work out your associates. All right, let me get back to the question so that we be together. Exactly halfway, that is 6 months through the year, Hibrides acquired 80%. And when I looked at this, I think it's supposed to be I there, and something like that there. Is it supposed to be like that? All right. We are told Hibrides. Check. Is that? Yeah, it's supposed to be HE here. Okay, Hibrides. Hibrides acquired 80% of the share capital of Sky and 30% of the share capital of Run. That sorts out one problem that we have, that is a group structure. So again, your group structure looks like this. There is your controlling interest in the sub, there is your non-controlling interest, and then finally there is your significant influence in a run. All right, so again, this is Hibrides, and then this is Kai. I think that should not be very difficult, and then this is a run. That is your group structure. All right, next we have to establish what we call the net assets. The net assets. So we do some bit of work under net assets. We're simply dealing with capital plus reserves, and I think that should not be very difficult to understand. I go to my financial position and I focus on the sub. The capital for sub is 200 and the premium is 100, and the reporting date figure there for retained earnings is 760. So let me do some bit of work just around that. I am now on the net assets part. Share capital, we suggested 200, and also here 200, premium 100, and also there 100. Then retained earnings, so 760. All right, now for the retained earnings at acquisition, we have to go to the profit or loss and establish what we had as brought forward retained earnings, and then add 6 months profits. That should not be very difficult. So there you go, you have got a 600 as your starting figure, but we got to get half of that, which is 100, so that we establish what we had when we started. Of course, that should give us a 700, not a 600, but a 700. All right. Fair value adjustment, there's a note that is given in the question. Let us go to note 1, I suppose. Note 1, down there. At acquisition, the fair value of Aaron's assets were reasonably represented by the book value. The same was true of Sky, with the exception of some land and plant. And these at fair value of 400 and 300 above book values. The plant had the remaining life of 5 years. Depreciation is charged to cost of sales. So let's do some bit of work and run with that. I saw for land we had a 400, and then for plant, all right, let me just drop that figure. And what about for plant? We had the 300, but for the reporting date we have to be careful, because we need to account for depreciation. So you say 300 minus, open brackets, then you say 300 divided by 5, then you multiply whatever, or you multiply whatever you find by 6 of that's going to give us the correct answer. Let me just remove that. All right, so there we go. If we do that, how will that look? That is precise, 270. Then further we are told in the note 2, in the post-acquisition period, the subsidiary is sold in what we call an upstream transaction, 120,000 worth of goods, transferred these goods to the parent to margin of 20%. Sky held 5/6 of those goods at the end. We need to work out that, and of course that is called unrealized profits. So we do the work. We say equal sign 120 multiplied by 20%, which is that. Then again you multiply that by, let me put these things in brackets so that we don't get it wrong. So that's what we have there. All right, when you do your summation, you should be getting a post-acquisition profit of 10. All right, so when you find the difference between 1710 and 1700, you get that figure there, and 80% of that belongs to parent, 20% of that belongs to NCI. That should not be very difficult. Now we go to the issue of goodwill, and I would like to go on top there so that we get our cost of investment and our NCI. Again, one of your competences under group accounting and many other topics, of course, is your ability to pinpoint spaces where you're supposed to get information from. We are told in the first paragraph about what we call the capital structure, but in the second sentence we are told that Hibrides acquired Sky by way of share exchange. Hibrides issued 5 of its own shares for 2 5 of its own shares for 2 Sky shares. The market value of Hibrides shares was 5. Of course, the share issue has not been recorded. It is the group policy value the non-controlling interest, fair value, and of course that is 410. Now, what what you observe is that when you go down and you check on the share capital figure, and we can also check on the share capital on top here, the number of shares in the subsidiary is 200,000 because the par value is 1. That should not be very difficult for us to understand. So what you do, you say 200,000 shares multiplied by 80%, of course, that's the interest acquired by parent. And then you multiply by the fraction that was mentioned in the paragraph, 5/2. Then you multiply that by the value of shares in parent, you should be getting a 2,000 or 2 million. All right. We're also told that the NCI was 410. So you get your 410, you push it there. The net assets figure at acquisition is that figure there. When you do your summation, you should be getting a 710. Okay, check for impairment. There was no impairment, and therefore the 710 remains. The next working, ladies and gentlemen, is non-controlling interest. Again, we don't have to worry about that figure there. We always start with the non-controlling interest at acquisition. Again, we remember that our post-acquisition profit was 10, so 20% of 10 is 2. When you add the two figures, you get a 412. Next, we deal with group retained earnings. Again, that should not be very difficult. When you go to your financial position, go down, Hibrides. What we have? Parents' retained earnings is 96. Again, that reflects also in the statement of profit or loss. Some of you could have seen that. And then we get 80% of the post-acquisition profit now, parent, that's 8. And then we get 30% of half of the profit after tax for the associate. Check your associate column. You should be able to see 100 there. Let me just take you there so that you don't say we can't see the 100. The 100 is right there. You can see there. All right, so when you do the maths, you will be getting 50 multiplied by 30%, that's a 15. All right, and then there's an aspect of impairment. Now, for the impairment, we can't do the impairment without or minus looking at what happened in the associate working. So associates are accounted for under what we call equity accounting, a process of recognizing the associate initially at cost, and of course making adjustments for either profits or losses. So now, when you look at your question again, we are told on top there, and perhaps, yeah, you can always make reference to the financial position, but on top we're told that we acquired this associate at 500,000, so I'll go right there, write my 500, and I already know that my profits from the associate is 15. I add that post-acquisition profits in associates. That's what I have there. Less dividends. I had new. What else do we have? Unrealized profits. I've got new, but impairment I should have. So for impairment, I'd like to draw your attention to a very important note that we need to look at together. I go down, of course, even in the exams, for those who do written-based exams, you have to flip your papers here and there, of course. Now, we are told in note 3 that there was no impairment for the subsidiary, but for associate, we are told that the recoverable value has now dropped to one of these two. The value in use is 790, and the fair value less cost to sell is 560. Of course, we go for the higher of the two, restricting ourselves, of course, to our interest, which in this case is a 30%. So if you say 30% of 790, you have 790 multiplied by 30%, you've got that figure. So we are dropping, of course, from 515 to 237. our impairment loss is therefore that much. You understand that? So that 278 is the figure that I was looking for to put here. 278 is supposed to be a minus 278. When I do my maths, I have got that figure to put in the statement of financial position, of course. So thank you very much. These are the major workings that you need to look out for. There is a note that I remember now that current accounts between Hibrides and Sky did not agree due to cash in transit from subsidiary to parent 4,000. Hibrides recorded a receivable of 25,000 at the end. Dividends were paid in the last month before the end. So you need to work out what we call cash in transit, and you need to also to work out what we call a reconciliation between payables and and receivables, of course. Okay, so the ideal situation is the instruction abstractly is as follows. You add back the cash in transit to your cash balance, and then you less the lower figure, which of course in this case will be the difference between 25,000 and 4,000. You less that one from your payables, and the higher figure, which is 25,000, you should less from your receivables. You should less from your receivables. So less 25,000 from receivables, and then less 21,000 from payables, and then add back the 4,000 to your bank. I hope that is clear. Take into consideration the fair value movements for land and plant. Please remember, land is increased by 400 and plant will be increased by 270. All right, do not forget that. I'd like to wish you all the best as you work through your question. Thank you very much, and I'll see you soon again.